What's up, everyone? It's Scotty with MoneyVest. So welcome on board for another Market Open live stream. We've got the most important inflation numbers coming out in less than 30 minutes. So this is going to be it. 8:30 a.m. Eastern, we've got the CPI numbers coming out, and that is going to be incredibly important, not just for the market, but for the Federal Reserve as well, and for the entire economy. So I'm going to break down every single thing you need to know. We're going to talk a little bit about other banks and what their expectations are. And JP Morgan pretty much released this entire page of probabilities and the outcomes and how the markets might react. So all of that is going to be discussed in this video. If you guys can see me, hear me, just give me a thumbs up. Just want to make sure the audio and the video is working well. So just give me a thumbs up in the live chat and we should be all set and all ready to go. So thank you so much for joining. And these right here are going to be the consensus expectations. CPI month over month, 0.3%. That's where the consensus is. Year over year, 3.6%. And ex food and energy, so core CPI, when you exclude for food and energy because they're a little bit more volatile, we're looking for 0.3% month over month and year over year at 4.1%. And I want every single one of you guys to participate. Every single person should participate in the poll for core CPI year over year. Are you expecting more than 4.1, less than 4.1, or at 4.1%? We've got that poll going on right now. So right now we're at 39 votes. And in the next 30 minutes, if I don't see at least 500 votes, I'm going to cut the live stream at 8:29. And we're not going to go over the not going to go over the CPI number. No, I'm just kidding. But definitely do vote, do participate, and we want to see where we are for our consensus for core CPI. And again, core inflation is really what the Federal Reserve is going to be paying attention to. Now, going over to Mohamed El Rain, and he tweeted about 3 hours ago, or actually I think an hour ago, it's CPI day in the U.S. with consensus forecasts looking for both headline and core CPI to have risen by 0.3% in September. This would allow the annual inflation measures to edge lower to 3.6% from headline, from 3.7%, and 4.1% for core from 4.3%. As to the balance of risks, I suspect that it is to the upside for these measures. Now, this right here are all the banks and Wall Street's forecast for CPI. Bank of America is sitting at a lower level of 0.25 and 0.24% for headline and core, and they are expecting 4% for core year over year and 3.6% for headline. Barclays is kind of in line with Bank of America, 0.3%, headline 0.26% core, and they're also expecting 3.6 and 4% for headline and core on a year-over-year basis. Citigroup, 3.6% headline year-over-year, 4.1% for core. Nomura is another Wall Street bank that is also expecting very similar to Barclays and Bank of America, 3.6% headline and 4% core. I think anything under 4.1% would be very, very bullish. I mean, imagine if core ends up under 4%, that would be ridiculously bullish for the market. But of course, we'll find out in less than 30 minutes. And we got Citigroup, Goldman Sachs, JP Morgan, Morgan Stanley, Piper Sandler, and TD Securities, including UBS. All of them expect 4.1% for core and 3.6% for headline. So on a month-over-month basis, we would be coming down for headline. So if you come over to the BLS's website, you'll notice that for inflation on a month-over-month basis, it is expected for headline to roll over a little bit. So if you come over to this headline inflation, over the last couple of months, it's been trending higher from 3 to 3.2 to 3.7. 3.6 would be lower from previous months, so we will be moderating a little bit. But if you come over to all items, less food and energy, we have been trending lower, which is good. And that is going to continue. That trend is going to continue down to 4.1% is what the expectations really are. Now, JP Morgan released this as a very, very big paper. I haven't read this yet, just so you guys know. And I'm reading it with you for the first time. And what they are expecting is a 45% chance, 0.3%, in line with consensus estimates. And JP Morgan estimates this outcome would be well received by the market and keep stocks on their upward trajectory. This case would support the case for growth without inflation. A print like this is not quite Goldilocks, but it is close, keeping Fed hiking expectations at none and done, basically a pause, and the firm said the S&P 500 could add between 0.4 and 0.7% under this scenario. So the most probable outcome, according to JP Morgan, is that they are expecting 0.3% increase month over month in line with consensus, and that's going to continue to increase the probability of no rate hikes anymore in 2023. And in this scenario, the markets could be up anywhere between 40 and 70 basis points on the day for the S&P 500. The next scenario is going to be 27.5% chance between 0.4 and 0.6% month over month increase. Although this case is not the most extreme scenario, the bond market would price in a more hawkish Fed, potentially raising the terminal federal funds rate to 6%. That would be crazy. And as with the previous scenario, the risk is that a more active Fed increase the probability that something breaks while also increasing the depth of the subsequent recession. And the market's move would largely depend on CPI component surprise the most with its gains. So what component is actually surprising to the upside? And in this scenario, obviously the markets are going to be down because nobody wants to see a better or hotter than expected inflation number and the Federal Reserve become more hawkish. And in this scenario, they expect the S&P 500 to be down between 75 basis points to as much as 125 basis points, or 1.25% to be precise. 20% chance, so this is the third most probable outcome, is between 0.2 and 0.3%. That's going to be a little bit better than what the consensus is. And in this example, obviously, you can expect the markets to rally quite a bit. This would likely indicate a dovish miss for core CPI, as the rise in commodity prices is a known upside driver. And this would be the Goldilocks scenario, and this could lead to a rally for the S&P 500 between 1 and 1.5%. And then a 5% chance is going to be higher than 0.6, which is going to be a very, very significant increase. And that's when the markets can be down 1.5 to 2%. And a 2.5% chance that it's going to be below 0.2%. And the S&P can jump between 1.5 and 2%. So what we're really dealing with are the tail events, which are 5% and 2.5% of anything that's very, very hot versus very, very cool. And then the most probable outcome is obviously consensus estimates, where the markets are expected to be higher by 40 to 70 basis points. But the next probable outcome is this one, where the markets could be down 75 basis points to as much as 1.25% if we come in hotter than what the expectations are. And this is according to JP Morgan. So, talking for quite some time. So that's where we are. Again, thank you so much for joining, everyone. Let's see. Sound video. That says blackmail. Are you putting dry powder in PayPal right now? You were talking about something that last month about doubling or tripling your PayPal position. Are you doing it right now? So time passed. I basically mentioned that as a fail-safe, as kind of like last resort. If I wanted to get out of PayPal, I would immediately dollar cost average with a significant position size, and then be able to bring my cost basis down to as close to the market. Wait, what? 15% down in mode? Wow. Really? That is incredible. Let's take a look at some of the other stocks here. So Fiverr, wow. Did InMode report earnings? Were they supposed to report earnings? Not quite. Wow, 15%, huh? Let me just take a look at some of the other stocks. SEDG. Nope, it's flat. Fiverr is flat. So it is nothing to do with, yeah, I got to check on InMode. What is going on with InMode here? Let's just quickly take a look on what just happened here. 15% down is quite crazy. Let's take a quick look here. Let's see if I can find a catalyst, because TradingView doesn't have anything on there yet. It's from 2 days ago, so we don't have anything on InMode yet. But if you take a look at, yeah, right now it shows 11%. Yeah, there's nothing really that comes up. That's weird. Down 10.7% right now, it shows on TradingView. Huh. Hold on one second. Let me just that's so weird. There's no catalyst, there's no news on this. Oh, okay. Okay, Sadi, thank you so much for mentioning that. I think that's going to be probably the guidance that they are so used to providing us. And they've done this so many times, right? So 2023 guidance. Let's see if there's anything. Yeah, nothing's popping up right now. But my guess is that they are providing some type of guidance which is one of the reasons why the stock is down right now, because they've done this so many times, right? So anybody who's been tracking InMode for quite some time knows that they've always the management always has guided for lower earnings, and then when the actual time comes, they've always beaten expectations. So they underpromise and overdeliver almost every single time. But yeah, 122 to 123 million, lowering full year 2023 revenue guidance to 500 million to 510 million dollars. Okay, that makes sense, because that's happened before, several times with InMode. Anyway, so going back over to some of the comments here. So PayPal, yeah, so that would be like a last resort, fail safe type situation. Not planning on doing that at the moment. The market doesn't have it. Price and mate. Let's see, what are you talking? But the market doesn't care because everything is priced in. Well, the numbers haven't come out yet, so we'll find out if the numbers are hotter or not that hot, or cooler than what the expectations are. But let's just continue. So this right here is going to be rents, and rents in the month of September on a year-over-year basis, down 1.2%. So as numbers have obviously increased substantially and then have come back down, we have seen on a year-over-year basis rents roll over, but that's not played a role in the actual CPI numbers, because there's a significant lag and it's not showing up in the numbers just yet. But according to apartment listing and rents, median rents have continued to fall, but we're not seeing that in the report just yet. Of course, eventually, if we do, a third of inflation is made up of shelter prices, so that can lead to significant downside for inflation overall. Yeah, lowering guidance, and that's again very, very normal for InMode to do. That's something that we have witnessed several times, and today, like most likely, will be a buying day for InMode, because this is something that we have seen and witnessed, and it's now down in the mid-20s. Mid-20s from an earnings perspective, from a growth perspective, and from a valuation perspective is really, really cheap for InMode, right? Incredibly low in terms of that valuation. So Yep. So that's exactly what we talked about. Vault, I think you mentioned that in a previous video and previous live streams as well. But this is also including selling covered calls after the aggressive DCA. Yes, that is true. Bringing your cost basis down to the market price as close to possible as you can, and then selling covered calls immediately to lower your cost basis even further and have an exit strategy on that stock. So you're right. That is the overall plan, but we're not there yet, because PayPal continues to show signs of, from a fundamental perspective at least, continues to be super strong. Of course, the sentiment on the price and the stock itself has been very, very weak. Government bonds starting to drop a little bit, 34 to 35 basis points. I did a video on this yesterday, very, very important video, so definitely do check that out if you haven't already. But TMF up over 1.2%, so back over 485, and TLT here also pushing higher, up over 41 basis points at the moment. So we'll eventually find out where hedge funds are with respect to their short positions. I did a video yesterday going over how the supply is constantly growing, and it's not going to be anything close to what we have already witnessed with previous stocks, like for example Tesla, GME, and all those companies that have seen this significant short squeeze. The treasury market is very, very big. In fact, the bond market's 3 times as big as the equity market. So the amount of shorts that they have is less than 0.5% of the overall global market. So it's not going to lead to a quote unquote squeeze, but the main thesis is really around the yields and are they going to drop in the future or not. So, yeah, InMode 2418. Yep. So we've talked about this already. Yes, Tesla John, I did finish my thoughts here on PayPal, because I was looking at InMode and it was quite surprising, right? Down over 15%, and there was no catalyst that came out. Of course, I think it's a very, very obvious why InMode is down, because it's happened so many times in the past, right? This has been the management's playbook since 2020. They've done this over and over and over again, where they underguide and then over-deliver. They underguide and they're over-deliver. They've done this so many times. And of course, now in the mid-20s. But yeah, going back over to PayPal, look, new CEO is already on board. I think the earnings are going to be a big moment for PayPal, because it's going to be the opportunity for the new CEO, for Alex, to kind of share his vision for the company and where the next sort of where the focus is going to be moving forward, because we know that the management, Dan Schulman management, they kind of gave up on that growth in active accounts. They kind of pivoted their strategy to active engagement, which has shown signs of significant improvement, right? I mean, average transaction per active account has grown over the last couple of years, but active accounts are stalling. And I think there should be a focus on both. They should be able to grow active accounts and at the same time be able to create more engagement. And yeah, I mean, November 1st is when the earnings are coming out, so that's going to be very important for PayPal, and we'll monitor what the earnings look like, what the guidance looks like, and not to mention what the new CEO has to say about the company. So, all right, so 184 votes, guys. Make sure that you vote, please, so that we can get a good consensus. 42% right now. Actually, a lot of you are expecting inflation to be higher, over 4.1% for core. Only 35% are expecting. Well, the consensus is actually the lower number here. The consensus is the minority, which is quite interesting. On core CPI. Below 4.1%, I think is going to be very, very good from a CPI perspective, from a market perspective. And we obviously do have 91% probability right now that the Federal Reserve is done with the Fed hikes, and a pause is what's going to happen in the next couple meetings. The market's pretty determined in no hikes here, and then cuts starting in June of next year by 25 basis points each. So 3 cuts is what the market's expecting in the second half of 2024. So we were talking about this. Again, food prices are rolling over very nicely. Shelter prices are also normalizing a little bit, but the big issue is going to be energy. Energy prices were higher in the month of September. Crude oil was up 8.5%, so I would not be surprised if this number turns positive. If this number goes from negative 3.6 to 0, or even plus 1, plus 2%. I would not be surprised if energy actually does turn the corner once again towards being on the positive territory once again. But like I said, shelter, food, very, very key numbers. They're kind of like the wild card for the market. Milan says 1.7 billion lotto winner in California. I don't believe it. I was just reading about it today. I don't think the draw has happened yet. Stop with the cap, Milan. Stop with the fake news. Is it really? Somebody won in California? 1.7 billion? That's insane. But anyway, Palantir, next support resistance in the weekly chart. So Palantir kind of surprised me a little bit. I'll be honest, I was talking about this with one of our members, and support level right now is going to stay put at $16.89, closer to $17. We've got a resistance up to $19. It did have a little bit of a head and shoulders that's still forming right now, but didn't quite materialize. And it's actually quite rare for a head and shoulders to not materialize. It was perfect. The neckline was at $13.75, came down to that level, didn't quite break down, bounced off of that support, and then rallied, another 30-40% here, back up to over $18. So very, very significant move to the upside. Fresh Aquarium says, if I won the lotto 1.7 billion, I would buy so many government bonds. Really? Really? Government bonds? Come on, man. I mean, you could create the entire market. Like you could be selling options all day long. Yes, someone won, just one person won the whole thing. Jesus, that is crazy. That is wild. Imagine how that person's feeling. Do we have the lottery winner in the chat right now? Come on, reveal yourself. Of course we do. We should. Okay, anyway, so we've got less than 12 minutes, folks, for the numbers to come out. Actually, about 10 minutes exactly for when the numbers are coming out. Yields are rolling over. We've got the Dow Jones up about 0.5%. QQQs are up 40 basis points. And the SPY up over 46 basis points. Volatility here dropping over 1.3, back under 16. And crude oil is also up over 2% at the moment, bouncing off of that support at $82, $83. It's almost back up to 85 at the moment. And Ethereum just a little bit over 1550, and Bitcoin here just under 27,000. So we're more or less here kind of waiting for the inflation numbers. Sean says, all right, you got me, Caddy, I won. Oh man. For Palantir, what helped a lot now is what happened in the Middle East. Palantir is delivering software for what is happening there. Yes, and that's kind of like the unfortunate part to some extent. I mean, a lot of these defense stocks, a lot of these AI stocks, a lot of the data science, intelligence companies kind of end up doing better even during times like these, which is quite unfortunate at the end of the day, but it is what it is, right? I mean, that's how the markets work, and yeah, Palantir did benefit from that. You're right. So Fortinet, Mara, both of them not right now. Fortinet will be looking at, I think in the low 40s was that number, and right now we're not there yet. $58. It's just been consolidating sideways. Did drop quite aggressively after the earnings, and I'm really watching this sort of green rectangle for Fortinet. And it also does seem like a bit of a head and shoulders for this too, because you've got this right here as a potential neckline, left shoulder, head, right shoulder, and if it does break down below 56, maybe there's a possibility for it to come down to low 40s where I would be ready to snap up some shares. Folks, do me a favor, share this live stream and drop a like so that this can actually get pushed out through the algorithm to more and more people that can join us for the inflation numbers. So make sure that you drop a like. Let's see if we can at least get up to over 100 likes right now. 360 people watching, so I would really appreciate that. It only benefit you, right? So the more people that have joined in, the more analysis, the more research they can share, and the more we can collaborate. Tristan, will the stocks go down when the Fed cuts interest rates in the beginning, and what is the historical response? That's a great question. So usually the short-term answer is yes, because as I've mentioned before, the Federal Reserve, the only reason they cut rates is why? Why would the Federal Reserve cut rates? Why? What are the two main reasons why the Federal Reserve would cut rates? Let me ask you guys this. What is the two main reasons the Federal Reserve cuts rates? What is the main incentive? So Sean says because something broke. Correct. And there's two specific reasons, right? So recession, yes. Recession, unemployment, which basically means recession. So yes, recession. That's one of the reasons. What's the other reason why they would cut rates? Unemployment too high. Yeah, so unemployment too high kind of falls under that recession umbrella, right? Recession happens because unemployment's too high. Alvin says inflation drops. What is that one specific word that I'm looking for? Recession plus recession or deflation. Yes, deflation, because I got it. So deflation, right? Those are the two main reasons why the Federal Reserve would cut rates. Now, we haven't seen deflation in a very long time. I think in 40 years, we haven't seen deflation. So, I mean, if you come over to all items reset, I mean, this is going back as far as 2003, maybe a little bit here in 2008, 2009. Okay, so we did see a little bit of deflation there, maybe a little bit in 2015, and then just like came down to 0.1% in May 2020. So the reason why they would cut rates obviously is recession and deflation. And what happens in recession and deflation obviously is when earnings are starting to compress, earnings are going down. So in the short term, medium term, yes, equity prices can indeed get affected, but when the rates start getting cut, that's to stimulate the economy. Cost of borrowing starts to drop. Businesses take on more debt, cheaper debt, and they can start hiring people. They can start investing in projects, and the growth continues. And that's the best window, in my opinion, to be looking at dollar cost averaging and buying stocks when we are down substantially and volatility is at its peak. So long answer short, in the short term, yes, there's a chance that equity prices do drop, but then that's also creating the best buying opportunity for us over the long term to be buying at those levels. Okay. Yeah, so Tristan, we need deflation in a major way because house prices have doubled in 3 years, not normal or sustainable. Yeah, so house prices are not included in inflation. I mean, it's just asset appreciation. What is included in inflation, obviously, is rents because that's the cost of living. That's included in the cost of living. So, yes, I mean, equity prices and asset prices in general, home prices have appreciated over the last couple of years, but that's not an indicator of inflation. Inflation indicator, obviously, is the CPI, which is what we're going to get in the next 5 minutes. Which is going to tell us a little bit more about, what's really going on. Luca, yes, we went over in mode earlier. It is down a little bit over 13% because that's the same playbook that the management's been playing for the last 2 to 3 years. They've always under-promised on the guidance. They've revised their guidance almost every single time, and then they have over-delivered. So it's almost always happened. So I'll do a video on in mode soon after the live stream from today. We'll take a look at what happened, why the stock is down, and then we'll go over some of the, there we go. So InMode lowers full year revenue guidance, and that's pretty much been That's happened so many times. I cannot tell you. If you've been following InMode for a long time, for over the last 2 to 3 years, you guys know exactly what I'm talking about. This has happened so many times. This company is underpromised on revenues, and they've come out with beat. Like look at the last. All right, let me just quickly go over this. Look at the last earnings. Beats. Every single quarter they've beat. Literally, the last time they missed earnings was in 2020. That was by 2 cents. Not even 2 cents. It was estimate was 16. They actually missed it by quite a bit of margin, 53%. But that was in 2020. In the last 8, 6, 12, 16. So in the last 16 quarters, they have beaten expectations for earnings and revenue. This has happened so many times. So ChargePoint we'll take a look at. We'll definitely take a look at some of these companies that you guys are mentioning, but now is the time to move over to inflation, folks. Make sure that you drop a like. Let's see if we can at least get up to over 100. We only need 7 more. And do participate in the poll. We've got over 400 people watching, only 300 votes. Let us know what your consensus is for core inflation. 4.1, above 4.1, at 4.1, or below 4.1%. So let us know in the chat. Let us know in the polls. And definitely do drop a like. We've got less than 3 minutes now. I'm going to do an audio check here very, very quickly. And then we'll be all set. 3 minutes. 3 minutes, folks. 3 minutes. The time is here. The Federal Reserve's main focus on inflation. This is a leading indicator for them. Even though it's a lagging indicator for the market, for the economy, it's a leading indicator for the Fed. And it's really what's going to come down to it. So I'll put that over here. I'll do an audio check once they come back. Make sure to let me know in the live chat, thumbs up if the audio is working well. And what we have over here is obviously the QQQs on the top right. I'm going to put the SPY bottom right. Yields are going to be behind me. So that's going to be the 10-year yields over here. And I'll put the screen right over there. And we should be all set now. 2 minutes. 2 minutes. 120 seconds now. 120 seconds. Like and share this stream. Like and share this stream so you don't miss out on the numbers live and the market's reaction as well. All right, quick in the chat. What is the core CPI year over year you're expecting? 4, 4.1, 4.2, 4.3, 3.9 year over year. What is the number that you're expecting? I'm going to put mine. 4.1% core CPI year over year. Just type in that number. I want to see a lot of numbers pop in. 4.3, 4.1, 4.2. Let us know. Let us know. Let everybody else know where you stand. 3.9. 3.9 would be crazy. I mean, under 4%. Anything under 4% would be wild. Max, come on. 7.1. 4.2, 4.1. Yes, a lot of 4.1 and 4.2s for those numbers. We got a minute. Under a minute. I'm going to go over to the BLS website as well. We'll put that up here. And we are ready. I'm going to refresh as soon as the numbers come out. So subject, CPI. And we're going to be focusing on this right here, right? All items, rises, whatever. And we'll take a look at what the actual number ends up looking like. So I'm going to turn on the audio.
All right, welcome back to Squawk Box right here on CNBC. We are just a few seconds away from the September CPI inflation number, also initial jobless claims, because of course it is Thursday. Futures this morning have been significantly higher ahead of this. Dow futures now up by about 140 points or so. S&P futures up by about 18 and the NASDAQ up by 70. If you wanted to take a quick look at where the 10-year is standing ahead of all this, the Dow futures right here, the 10-year has been sitting just about 4.54%. Rick Santelli is standing by at the CME in Chicago. Rick.
Yes, and it's dropping as if somebody thought they had the number, but they're wrong because it's hotter than expected. CPI for the month of September headline expected up 0.3. And many are saying, if you extrapolate this number, we're in the twos. Well, it's up 0.4%, up 0.4%. Still don't see a revision to up 0.6 in the rearview mirror, because of course up 0.6 was the highest since June of 22. Strip out the all-important food and energy, which is what I was referring to with that extrapolation. It hovers at up 0.3%. That is the second month in a row it's been there. We haven't had a revision yet. The prior 2 months were the lowest since February 21. We had back-to-back up 0.2, but it's now up 0.3, and year over year, 3.7. Year-over-year headline, 1/10 hotter than expected, exactly as in the rear-view mirror. So that's 3.7 back-to-back. The recent low water mark there was 3%. That was in June. That was lowest since March of 21. Now, this is my favorite year-over-year core, which, by the way, hasn't been below 4% since May of 2021, is now 4.1%, exactly as expected. However, we have made progress. It moves from 4.3 to 4.1. As I said, still haven't been under 4 since May of 2021, but 4.1% on its own is the lowest level since September of 21, when we were at 4%. Now, let's go to initial jobless claims expected up 210,000. Darn close, 209,000, and last month revised up 2,000 to 209,000. Back-to-back 209,000. Let's look at it this way. We haven't been at 250,000 since the first week in August, just to put a face on it. And continuing claims, always a month in arrears, actually popped the handle. Expecting 1,675,000, it barely popped up above 1.7. 1,702,000, and in rearview mirror, a subtle upward revision from 1,664 to 1,672. We haven't been above 1.7 million since the second week of August, when we were 1,719,000. Suffice it to say that interest rates have moved up a bit. If you were to look at a 2-day chart, what you'd find is that today we are looking at 2-year note futures above yesterday's high yields, never dabbled below. 10-year, on the other hand, are aiming for yesterday's highs, but still haven't come to it, but have done some work under yesterday's lows. So should we start to trade above yesterday's highs, we could call this an outside day. Technically significant. I would pay attention to that dynamic. Becky, back to you.
All right, Rick, thank you very much. Again, we're watching that jump right now in yields and a little bit of pressure on what we've seen with the futures. Stock futures have given up some of their gains, but you're still talking about them all in positive territory. Steve Leisman joins us again right now with more on what he's seeing on this. Steve, what do you think?
I'm looking over it. I mean, obviously you had a pop in gasoline prices, up 1.5%, maybe a bit less than had been expected, but still, that's a big number to the upside. I'm looking at used cars falling 2.5%, apparel falling 0.8%. Looks like there was a bit of a surprise in shelter. I just want to scroll down here and see if I can find the owner's equivalent rent. That was 0.6. Yeah, it ticked back up, which is kind of contrary to expectations. On the other hand, we did have a decline in medical services. We're down 0.3%, or sorry, up 0.3% on that, and also transportation services were up 0.7 with a 4.9% increase in airline fares. That may also be passing along higher fuel costs into the ticket price there. I think this is the kind of thing that tests the market's mettle for figuring out, is the Fed really done here? I think it is, and I think there is some tolerance for this kind of oscillation in the number, a bit of higher on the headline, but right in line on the year over year when it comes to services. And while I'm talking here, guys, I just want to see the Fed probabilities, if they have changed at all. And they did a little bit for December. They remain below 10% for November, and they're up slightly above 30, call it 33%. They were down below 30% before we went into the number here for December. I still think the Fed is on hold here. I think there's some tolerance. But again, as I said, the data has to behave. We have to be in this situation where the Fed can be confident that inflation is gradually coming down. But so far, what I've heard from Fed officials, the burden of proof is on hiking again, not on holding.
Okay, Steve, thank you very much.
Okay, coming up after this, you don't want to miss this. An American business leader.
All right, everyone. So inflation numbers coming in, I would say a little bit more mixed. By the way, just want to make sure the audio is good. So just give me a thumbs up if everything is working okay. But we did see QQQs drop, quite aggressively here, down a little bit over 37, close to 40 basis points. The SPY also dropping a little bit over 35 basis points here. And the yields spiking back up to 4.6%. We did get month over month 0.4, which was a little bit hotter than what the expectations were. Year over year 3.7, which were also a little bit hotter than what the expectations were. Core came exactly in line. 0.3% expected month over month, came in at 0.3%. Year over year 4.1% expected, came in at 4.1%. So we got two meeting expectations and two misses, no beats on the positive side. And as a result, we are seeing a little bit of a pullback. Now, shelter prices and energy, they were both higher as expected. So if you come over to the PDF, you'll notice that shelter was up 0.6%. That is actually a pretty substantial number month over month. And we haven't seen this since May of 2023. I have no idea where apartment listing gets their number from. Maybe like on, I don't know, the more recent numbers, they're seeing rents down. But like this has been an ongoing trend. There is not a single month where shelter is not up at least 0.3%. It just hasn't happened yet. And year over year, we're up 7.2% for shelter. Now, energy, we talked about fuel oil, which was crude oil, up 8.5%, and it was up exactly 8.5% in the month of September. And year over year, we were expecting it to turn almost positive. What you'll notice is it didn't quite turn positive, but look where we are. We are about as close to zero as it gets, right? So we have bounced right back up from negative 16% year over year to now negative 0.5%. So maybe one more month of a positive momentum higher. So crude oil in the month of October is actually down, I think a little bit over 6.6%. So if it stays this way, maybe there's a possibility that, okay, energy year over year continues to be negative in deflation. But if these losses kind of get recovered rest of October, if you see it go back up to over $90, $93 a barrel, and a lot of the losses get wiped out, then there's a possibility that we do start to push back higher for energy, right? It starts to go back above in the positive territory. But shelter prices, as you'll notice, that they were declining. They're still going down on a year-over-year basis, which is good, but the rate of that decrease is really, really small. The disinflation is just taking its sweet time. Food prices down from 4.3 to 3.7, so that's good. And then we did also have vehicle prices coming down to almost at 0% level. So coming back over to this, we did have used car prices down 2.5% month over month and down 8% on a year-over-year basis. And utility gas service down 19.9%, almost 20% year-over-year, and down 1.9% on a month-over-month basis. So the Federal Reserve expectations still pegged at 92%, but we have to give it some time because it does change after 15, 20 minutes here. And then let's just quickly go over to Econ Day. And that is going to tell us where the numbers actually ended up, right? So 2 misses and 2 meets on the overall numbers here. So 0.4% coming in, a little bit hotter than what the expectations were, 3.7 also higher, and then core coming in line with expectations and markets responding not in the best way. And we are flat on the NASDAQ and on the S&P right now. It's kind of hard to make of, by the way, jobless claims numbers came out at 209,000. And the reason why jobless claims are also very important, by the way, I've got a short coming out for this as well later today. But initial claims is one of the best indicators, one of the best leading indicators of a recession, and the fact that unemployment can be a little bit more concerning, right? So every time initial claims push higher, and I'm really watching that 400,000 level. That 400,000 level, we haven't breached that yet. We are still really, really low. We reported 209,000. So it needs to more than double on a week-over-week basis before it starts to become really concerning from a recession standpoint. So we're not there yet. That, along with the uninversion of the yield curve and the delinquency rates, are some things to really pay attention to from a recession standpoint. But yeah, like when it comes to inflation, it's kind of hard to make what to make of these numbers because on one hand, you've got core coming in line with expectations, but on the other hand, you've got headline, hotter than expectations and kind of leveling off a little bit at 3.7%, which, again, if the Fed's target's 2% for core, we're a little bit over twice that number right now. And the last thing we really want to see is for these numbers to level off, for them to be a bit more persistent. And, I mentioned this a few months ago that it's much easier to go from 9 to 4, and it's significantly more difficult to go from 4 to 2 or 4 to 1, right? 9 to 4 was much easier, right? Because we were getting that supply demand kind of back in balance, hitting equilibriums with prices. So economy is reopening back up. So there was a lot of reasons why it was much easier to go from 9 to 4. But now is the real game. Now is the real challenge for the Federal Reserve to go from 4 to 2% or 4 to 1%. And I think that's going to be a bit more persistent. And it's kind of hard. I think given the numbers today, like I said, I wouldn't be surprised if the Federal Reserve kind of sees these numbers and thinks to themselves that maybe one more rate hike is a possibility in 2023. I think I've been very, very vocal about this. I think there's a possibility that the Federal Reserve continues to hike rates maybe one more time, because you've got a very strong labor market, right? Unemployment just does not cave. Jobless claims still coming in at really low levels. Unemployment rate continues to be at under 3.5%. Unemployed persons still 6.3, and that ratio that we talked about, JOLTS to unemployed persons ratio at 1.55, right? That's that just goes to show how strong the labor market is, 1.51, right? So unemployed persons 6.3, JOLTS increased again. So businesses are hiring, they're opening up these positions at 9.6 million job openings. So you've got, on one hand, a very strong economy, very strong labor market, and inflation, a bit more persistent. Of course, there's lag effects to this. So I don't know. I'm kind of like on the fence that the Federal Reserve is not done yet. I could be wrong, and I want to be wrong, but you never know. I think 25 is still a possibility. Maybe markets underscoring the idea for 25 basis points. Guess we'll find out eventually. But all right, let me just go over to some of the comments here. Caddy, they need to challenge the Fed here on their shelter numbers. It is driving Fed policy with bogus numbers. All market data has been pointing to lower for quite some time here. Yeah, I mean, that's what I don't get. I mean, let me ask you guys this. Have you actually seen rents go down? We've got over 630 people watching, and I'm sure at least some of you, or not all of you, like are have experience, either are real estate investors or are, tenants yourselves. Have you seen rents go down? Have they actually decreased on a month-over-month basis? Because CPI is suggesting something else, and the actual numbers on the ground, according to apartmentlisting.com, even Zillow reports are suggesting that rents are down year over year. Like, how? I mean, Jeremy Siegel has been very vocal about this. Makinda says rents are not going down anywhere. A lot of you guys pointing to no. Frank says rents have softened for sure. Yes, they've softened. So in other words, we have seen disinflation, right? We've seen the rate of increase go down, but they're still increasing. And it's kind of interesting how inflation at the end of the day is actually calculated, right? So year over year increases. If the rate of increase goes down, it's still an increase, but it's considered as less of an increase, right? So less inflation, basically, disinflation, because that rate of increase is going down. But yeah, I mean, rents are still elevated, and they have been, and they haven't really been going down. So I think it's going to take some time. It's really going to take an event for rents to roll over. Energy did its part. Food is trying to do its part, but shelter prices are just not. They're still going down, but again, the rate of decrease is nowhere near close to the rate of increase. I mean, we went from 1.5 to over 8% in a matter of 2 years, exactly 2 years. March of 21, we were at 1.7, and March 23, we were at 8.2. So 8.2 divided by 1.5, we're looking at 5.5 times increase. We went up by 5.5 times, right? And that was an increase of 700 basis points. And in the last 1 year, a little bit over 1 year, since March 23, actually just under 1 year, we've seen rates for shelter go down by 1% or 100 basis points. So that's another problem, right? When things go up, especially when oil prices they go up, it takes time for them to come down. I mean, crude oil, even if oil prices are down over 40% from their highs, crude oil is not. I mean, gas prices are not. At the pump, they're not, because they take an average. They take an average of the 3 months. It's the same thing with kerosene, same thing with the oil that's being used by airplanes and all the operators. That's exactly why, even if oil prices are down 40%, it doesn't get reflected in the actual prices paid at the pump or the airline fares, because it takes a 3-month average, and that takes time to develop. So I think that's where we are. And let's see. Sujit, thank you so much. I appreciate that. Nice videos and good analysis. Thank you so much. Yeah, Mike says I'm keeping my rents the same, and I've got friends too. Rents have increased 35%. Restful says, Srinivas, thank you so much. I'm doing well. How are you? Trucking Forever says, I've been in property management for years and no rents are sky high. Just to give you a perspective, the house down the street for mine sold for just under $1 million. Yeah, I mean, that's where we are. And I was talking to one of my friends in New Hampshire. He's a real estate agent as well. And he's telling me that, sellers are very, very stubborn, that even though properties are on the market for longer, they're not willing to lower their price. And the buyers obviously can't meet the seller because of the higher cost of borrowing, since mortgage rates are at 7-8%. So they can't put in a higher offer because of the rates. So this has been the largest discrepancy between the buyer and the seller in terms of offers that are coming in. They're still getting multiple offers, but they're way below asking, and the sellers are too stubborn to lower their price. And I think the part of the problem is the seller's holding on to a home which was financed at 1-2%, and the buyers are now looking at a market that is 7-8% mortgage rates. So they obviously don't want to pay as much, and sellers are not willing to accept anything less. So they're going in with so much days on market. And for those reasons, I think it's a huge problem right now. Yeah, McKinnon says there are 15 million vacant properties in the U.S. I have a few properties in L.A. Alex says USA, and I have increased rent 2022, and I'm raising again from January next year. My renters, knowing that it is much more expensive, they are all staying. Yeah, that's not all of them are mortgaged at 2%. You're right, but again, if you take a look at mortgage rates, when was the last time we saw 7-8%? Right? Even if you take a look at, okay, they weren't financed or 1-2%. I can tell you, if anybody is investing in real estate, most of them refinanced in 2020 or 2021. Most of them did, right? If they were holding on to higher rates, they most likely refinanced. But even if they did not, even if they, let's say they were holding from 10 years ago or 15 years ago, when was the last time we actually saw mortgage rates at 7-8%? Probably not in a very long time. I can't even remember, but let me just reload this chart so we can take a look. The last time mortgage rates were this high. So this right here is the chart that shows you a little bit. So, okay, all the way up here. Okay, so 30-year mortgage was 7% in 2022, of course, but the last time, if you go back a little bit further, 30-year was back in 08. 08, we were sitting at 6.3, 6.4. So again, it's been well over 14 years, 15 years that rates are this high. So even if you think about a 15-year, 20-year, 30-year mortgage, it's most likely sitting at sub 4, most likely sitting sub 4, sub 3.5. And that's very easy for sellers right now to keep financing at those rates. The buyers can't really stretch themselves that far. Yeah, so that's where we are with inflation numbers and, of course, the state of the market. Matchbox says, I wouldn't lower my prices either. Why sell at a lower price and then need to buy a new place to avoid taxes with these sky-high interest rates? Not going to get rid of 3% interest rate for an 8%. That's exactly my point, right? That's right, and that makes sense. That's a rational investor, and why would somebody lower their price for a property that's financed at 2 to 3%, and then you'll have to take that cash out and then, of course, invest in something else or buy something else at a much higher rate? Doesn't make any sense. So it's a problem right now. We'll see eventually what ends up happening. I'll maybe do a more detailed video on the current real estate market, but that's really where we are. Yeah, property taxes also through the roof in certain areas. So yeah, I mean, that's where we are, and I think that this is what makes the community so great, is because you guys can all share your experiences and what you are actually witnessing on the ground, and people can kind of take that, use that analysis into their own decision making. But nonetheless, QQQ's here trying to recover a little bit, so we're back in the green, up over 20 basis points. We have the SPY here up over 29, 30 basis points, and the Dow Jones also up over 36 basis points at the moment, with the 10-year yield slightly up over 40, 42 basis points right now. So we do have both the equity markets and the bond market, especially the treasuries, pushing higher at the moment. In mode, still down over 11.7%. We already went over why they were down. So outlook cut. And revenue they're expecting now between 500 and 510 million in 2023, down from its previous 530 to 540 million. They said they expect the third quarter earnings of 59 to 60 cents on 122.8 to 123 million dollars in sales, which would miss analyst forecasts on both top and bottom lines. And the outlook cut stems from slower purchase decisions in the third quarter due to drop in aesthetic activity during the summer. And InMode is also dealing with the constraints in the financing of medical equipment that have dampened its platform sales activity as well. So that's where we are with InMode at the moment. So Alan, just went over InMode right now. So Gino says, want to join Discord? How much? Great info insight. So link's going to be down below if you want to join. I will put the link in the description. It should already be there. Feel free to join. I mean, there's a lot of individual stock reports that we're sharing with all the members. And look, my team and I is putting a lot of effort into this. And I mentioned this in our Discord earlier today that, I know it's a little bit more time consuming. So if you come over to our stock reports, so this right here is going to be the channel for stock reports right here. So if you come over to this channel, I'm going to constantly be updating this channel with new reports. All you have to do is literally just pick up whatever stock you want to analyze. Like, for example, if you were interested in Visa, Caterpillar, this week we've got 5 more stock reports coming out. And I mentioned earlier that, these are going to be a bit more sort of like boring or time consuming to read because they are pretty extensive, right? We're putting in a lot of time to create these reports. It's going over everything: product, services, SWOT analysis, so strengths, weaknesses, opportunities, risk, the quantitative analysis of the fundamentals. But it's to your own benefit because if you're putting your hard-earned money into these companies, you want to know everything. And the only way I would know that you're reading these is because you are disagreeing with something that's mentioned in this report, or you're adding your own analysis. You're kind of mentioning that and participating in the discussions for these companies. So we've got this discussions tab where you can, again, communicate, engage with other users, members, and we can talk about different stocks, right? So I think it's going to be super helpful. It's going to be a collaborative effort because I'm not going to be the only one that's going to be creating these. I want your insight. I want your analysis and your collaborative effort in going over these companies. So what are the strengths? What are the weaknesses for these companies so we can better analyze them? So guys, InMode, I have already gone over a couple of times already. Lower guidance. They do this almost every single time. They've done it several times in the past, but in the last 16 quarters, they've always beaten their estimates. So this has happened time and time again. They have under-promised and over-delivered every single earnings in the past, but in the low 20s, mid-20s, I think the valuation starts to become very, very attractive. It's got one of the best balance sheets. It's got consistently growing revenues and earnings. So even with the 12.5% drop, something that we have already seen in the past, my conviction doesn't waver for this company. So we'll be looking to buy on this sell-off, or maybe even sell some puts. Oil, yes. So let's take a quick look on oil. Pushing up 1.9% right now. So bouncing off of that support level that we have talked about at roughly around $80, $81 per barrel. So we're starting to see that momentum back up. And energy, so far, I would say it's been on a very nice rally. And did a company analysis on a lot of these companies in another video. But yeah, Chevron, I think ExxonMobil is buying a company, right? Acquiring for, I think, close to $60 billion. Pioneer to merge, deal valued at over $60 billion. 59.5, 59.5, $253. And PXD is the company, and that stock is trading at $242 right now. So, yeah, so very nice move to the upside for energy overall. All right. Guion Diaz, what time is CPI? It is going to come out in 35 minutes at 9:30. Yeah, in 35 minutes, we're gonna get the inflation numbers. Hims and hers. I think I've done a video on that in the past. I've done videos on Hims and hers before. Ferdinand, thank you so much. I appreciate that. Can't get enough of your videos. I appreciate that very much. Thank you. Microsoft owes $29 billion taxes. Will that impact the stock prices? I don't think so. No, I think that's just noise because we learned from yesterday that Microsoft is going to fight that with the IRS. And that's going to take years. So I don't think that's going to be a big, that's going to be any material impact on the stock price. However, it is 40% of the company's profits, right? Every single year, the net income, $70, $80 billion, $29 billion is a pretty big number. But Microsoft pretty much made a very definitive statement saying that we have paid all the taxes we have owed in the US and all over the world. So we don't believe, or we don't agree with those adjustments that they've made. So I don't think that, Alvin says next month this time. Man. Yes, Unicorn. CPI has already come out. We were just joking around a little bit. IVMV, or what is it? What do you think about IMVT and healthcare in general? I'll take a look. Review CMI instead of Caterpillar. We'll take a look at that as well. More room to grow as well as compared to CAT. PRTYQ shenanigans and will turn into a Hertz-like play. Man, there's so many stocks to go over, right? There's so many stocks to analyze, one at a time. So IMVT, 4.7 billion market cap. We are looking at consistently generating losses, man. Come on. You guys know better. You guys know better. If you're on this channel, you guys know better what type of companies we look for. It's been consistently just massive amounts of losses after losses. There doesn't seem to be any revenues. 100% increase year to date. Great forecast. Amazing. I mean, this is the type of fundamentals that I really look for. I mean, this is just perfect. Negative 46 cents per share, then negative 46, 46, 55. Amazing. Yeah, no earnings multiple. Let's take a look at their balance sheet. Well, they've got net debt. I'll give them that. They've got negative net debt. Let's see. Share count. Perfect. I mean, that's exactly what we want to see for share count, right? Lots of dilution. 14 million, 130 million in 5 years. It's 10x increase in share count. Amazing. Amazing fundamentals. Are you sleep deprived? I probably am. It's just been long days and long weeks with all the projects that we're working on. One of these days, I'm definitely going to be sleeping for 24 hours straight. Entry point for Home Depot. Let's take a quick look. Yeah, so next 30 minutes, I'll just analyze stocks for you guys. So if you have any companies you want me to quickly go over, I'm going to go over fundamentals, technicals, share my 2 cents, and we'll try to cover as many stocks as possible. So I'm not going to be spending 10 minutes per stock, but we're going to be quick, maybe 4 to 5 minutes per company, so we can get at least 5-6 companies out of the way for you guys. And they have to be quality, right? And they have to be companies that we haven't heard of, companies that we can actually learn more about. I swear to God, if somebody says Tesla, if somebody says any of the Magnificent 8 stocks to analyze right now, I'm going to lose it. The companies that we haven't analyzed before, okay? TSLY. Oh, please. Yes. So first of all, Home Depot, lots of consolidation sideways. I would say a very nice support at 248, 265. So that's really where the support level is going to be. Resistance at closer to 334. So right now it's just been trading in this consolidation range pattern where getting rejected at 334, getting validated at support at 265. Very good fundamentals, consistently growing. So that's good. Home Depot is a phenomenally, very high quality stock. So fundamentally, I've done videos on them before, but this green rectangle is going to be that support. Now, look, REITs are going to get affected. With higher yields, REITs get affected. Most of them will get affected. Why? Why would REITs and dividend stocks get affected? Can someone tell me? Let's see who can get this question. Tesla, please. Oh, man. SYM, I'll take a look. High rates. Yes, high rates. And, it's all about relative selection, right? Higher opportunity, like opportunity cost here. So if the 10-year yield or the 5-year, the 6-month, 1 year are paying you higher yields, there's no risk involved with those types of assets, which is the treasury yields. Why would investors look at REITs or dividend stocks and take on that additional risk, right? It's all flight to quality. And as yields continue to go up, that does represent not the best environment for REITs or dividend stocks. So, but nonetheless, I mean, $44, $48 is going to be a very strong support. And, if you do eventually expect yields to come down, which I do, and I'm also investing in the long term for REITs like Vici Properties or Realty Income Corp or Digital Realty or any of the other American Tower, for example, then these could be considered as buying opportunities considering how oversold they are and trading at support at $40, $45. All right, so SYM, $10 billion pipeline of the charts, growth or ODD setting up to be the next ELF. Both look very strong. So SYM. Let's take a quick look for Frank here. So very nice bounce off of that 200 SMA. $3.3 billion market cap. Very low profitability. Robotics and automation, so technology company. 244% increase. And does seem like turning the corner. Wow. Man, Frank, you do come up with some very good companies here. I'm going to give you that. You do come up with some very underrated gems. Symbiotic. And earnings per share expected to grow pretty rapidly, though. Like 22 cents to $1.29. That's over 5x, 6x actually, over the next 3 to 4 years. And revenue also from $1 billion to $3.94 billion, almost $4 billion. It's pretty massive expectation. Negative net debt, that's good. Share count's been flat, although increased over the last couple of years from 33 million to 57. The last 6 quarters, it's been pretty stable. But yeah, I mean, I'll add it to the watch list. We'll definitely be taking a look at this in our future videos. Okay, let's just see. Helion, Ritesh, I feel like we've already gone over that. CSIQ, Canadian Solar. Okay, so solar company and consistently growing revenues, earnings 25%. So solar sector is down overall. I would put down this as a support. Looks like we have done some analysis on this. But yeah, this is previous resistance support. Right now it's coming up to that resistance again. At the moment getting rejected at around 2350s. So yeah, there's a lot of solar companies. I mean, margins are not great, but they're not bad either. I mean, they're okay, and earnings are expected to kind of flatten out a little bit, and then 2026 is when the growth is coming back in at from $6 to $9.82. That's a 50% increase. But I like Enphase in the solar sector. I think Enphase is a stock that I like in this sector. So STNE, I think we've done some analysis in Stone Co. So decent growth in revenues here, but profitability is a bit of an issue. Flat year to date, earnings expectations slightly higher. Negative net debt, so that's good. Shares outstanding have also been more or less flat in the last 8 quarters. I think it's on the watch list. It's on the watch list because profitability is a bit of an issue right now. Revenue is growing, but we are seeing losses also kind of mount. All right, VITL. You know what? I'm going to create a lot of these lists here because it's impossible to go over all of them. But let's just do this. We'll create a list for YouTube live streams. All right. And I'll add all these. All right, we got PL, Target, Florin. We've already covered Quest Diagnostics. What is the ticker symbol for them? So we'll add VITL. PL, FNOX. Nope, FNOX is listed on what? It's Swedish. So, or is that Swedish? Gotta look at that flag here. But PL was one other one. Planet Labs. Yes, Kevin, I did take a look at Walgreens earnings. I've got a video coming out on Walgreens later today. So that's going to be coming out. Like ELF, you will love ODD. Love to hear your thoughts on ODD. So ODD will also add to the watch list here. And then we'll add SecureNet. What's the ticker symbol for that? Coop. Is Uber going to list into the S&P 500? So they need profitability. They need profitability on a very consistent basis before they get listed in the S&P. But Airbnb is going in there. So Airbnb is going to be a part of the S&P 500 here very soon. All right, so I'm going to add these to the list. We'll analyze them. We'll do some analysis. Maybe I'll do a video on them. In the future. But quick check on the markets here. QQQs are still struggling a little bit after the inflation numbers. Yields are still over 4.6 for the 10-year. And we got the S&P down from its highs after the inflation numbers came out, and we're still up over 16, 17 basis points. But we're basically just flat. We're very, very flat right now. So we'll do another poll asking you guys for markets today. Green, red, or flat. Okay, let's just do a few more. We'll do very green. Then green, flat, red, very red. We'll just do one of these together. Red or very red. Also, what JP Morgan mentioned in their report, so if you come over to what they said in line with consensus, we came in hotter for headline. Core came in line with consensus. So I think this was mostly a assumption for core, if I'm not mistaken. I think it was mostly for core is what they're really pricing for. So according to their analysis, I mean, the market should be up 0.4 to 0.7% because we did get them in line at 0.3%. But of course, the headline came in a little bit higher. But they also mentioned here that 20% chance between 0.2 and 0.3%. This would likely indicate a dovish miss for core CPI. So I think a lot of this analysis was for core CPI. Sorry, guys. It's just been a lot of long nights. Yeah, so Walgreens did a video on them, Kevin. I will be posting a video here very soon. But yeah, make sure that you do participate in the poll as well for the markets today. And let's just quickly go over big tech. Why not? We'll just go over some of the technicals before market open. So starting with Apple. Apple's got a big resistance coming up at 180. So yesterday we had a very nice move to the upside, and now we're sitting roughly at 179.86. So $180. So this right here is going to be that level to watch for Apple as it's coming up to its lower high, right? So this is the lower high and the lower low pattern for Apple. It's going to be coming up to that resistance so right now. And then, of course, Amazon, very, very similar pattern of lower highs and lower lows. So Amazon and Apple are the only two stocks right now that are trading in a downtrend, that are trading in a bit of a lower high and a lower low pattern, right? So that resistance all the way up to as much as 137, 138. So that's going to be that level to watch. And of course, we got that lower low sitting down to 121. Tesla, on the other hand, Tesla's quite interesting. Tesla is very interesting right now because yesterday and the day before, we had a double rejection exactly at the lower high. So if you come over to the 5-minute chart, you'll see that, we got rejected exactly at that resistance for Tesla before, of course, sliding lower. And right now, pre-market, we're slightly down. So we're kind of filling in this lower high and this higher low. And that's going to set up perfectly right on earnings. So if you see this earnings line, that's going to be coiled in perfectly for a huge move for Tesla for when the numbers come out. So, we already know the delivery numbers. We already know the year-over-year growth in deliveries. Revenue expectations are $24.3 billion. EPS sitting at 73 cents. Microsoft starting to break out a little bit, so it's showing signs of some momentum. However, pre-market, it's down about 85 basis points. Market is weak a little bit after those CPI numbers. And Google here also coming up to its resistance at 144. So that's going to be that level to watch for Google. Enphase, ENPH, pre-market, slightly higher. It's inside this green rectangle, which we have labeled as a good deal for a very, very, very long time. Can't even remember when it was last time. Can't remember when we actually put this good deal area for Enphase at those prices. I think it's been a long time, and the prices have continued to come down, and they're now finally sitting around our good deal areas. Tesla truck, while cool, but not for the broader truck buyer consumer. Frank says, I'm planning on trimming Tesla shares soon, not confident on their third quarter earnings or them moving forward for the next couple of quarters. Yeah, I mean, with respect to price cuts and the higher rate of interest, I think demand is certainly going to be a bit of an issue. And I don't think Tesla's demand can be measured against Rivian's or Lucid or any of the other smaller EV manufacturers, because their marketing spend and their numbers are really, really small right now. And they're also aggressively marketing with new products and new models. So just because, Lucid or Rivian or any of the other smaller EV makers' deliveries came in stronger doesn't mean that Tesla is going to be strong, or that does not represent Tesla's market at all. I don't think it does. Because Tesla's now delivering millions of cars per year. Rivian goes from 10 to 15,000. That's a 50% increase. So Tesla's in its league of its own when it comes to electric vehicles. And I think it's going to come under some pressure as we deal with as we deal with the margin pressure, the price cuts, the higher rates. So Shino, as I missed the Enphase good deal train yesterday, I added 25 more shares at 127. Now my average is 142. That's good. That's great. And yeah, I mean, like I said in my previous videos as well, I mean, long term, a few dollars here and there aren't going to make much of a difference. And one of the things that I forgot to mention in that video as well is that the opportunity or the risk of missing out on a stock that you waited for, let's say, another 10% drop, the risk of that is far greater than the potential. No, what I'm trying to say is basically the risk of 10% lower is not worth the missing out on the potential reward that can come over the long term from investing in that company. So I hope that makes sense. Like, for example, if it comes down to 115, 110, and your fair value is, let's say, at $90, over the long term, it's not going to make that much of a difference if you expect the stock price to be at $200, $250, $300, because that risk right here, that small amount of risk that you're waiting for, is just not worth it, right? It's just not worth the risk of completely missing out on the entire move. So yeah, that's where we are. 15 more minutes till market open. I'm probably going to cut it right here because I'm going to spend some time with our members. I'm going to send out some alerts and trade myself. So thank you so much, everyone, for joining in for this live stream for inflation numbers. Came in a little bit hotter, especially the headline numbers. Core came in line with expectations. The markets are very, very non-reactionary. We've got a very flat market right now. QQQs and S&P, they're both about as flat as it gets, and the yields are certainly moving higher. So thank you so much for joining. I really appreciate it. Again, links are going to be down below if you want to join our MoneyVest community. I would really appreciate it. And again, if you have any questions, feel free to reach out. And as always, happy investing. I will see you all in the next video. Take care.